Hello and a very warm welcome to the 37th episode of CMS Pensions Lawcast. I'm James Parker, I'm a partner in the CMS Pensions team. I'm very happy to welcome Myles Pink, who is a partner in LCP's insurance de-risking team. And we're both going to have a brief recap on the de-risking market. We're going to look back at 2021. I think we've got a decent idea of what the volumes were in 2021. I think importantly, then look forward into 2022. And if you're a trustee and you're considering either putting together a journey plan or transacting in 2022, really what can you expect and what are the themes that we think we'll see in the market during the year? So Myles, I think we've probably got a rough idea of what happened in 2021. Can you just give us the highlights?
Yeah, the insurers haven't all reported their final numbers in, but from what we can see, it looks like the bulk annuity market for buy-ins and buyouts is going to be confirmed at around 30 billion. That compares with the other two largest years, 2020 of about 32 billion and 2019 of a staggering 44 billion. So 2021 could easily be the second or third largest year for buy-ins and buyouts that we've ever seen in terms of volumes. What's quite interesting to look through is how these volumes break down between buy-ins and buyouts, because about 5 years ago, 2/3 of bulk annuity volumes in this market were associated with pensioner buy-ins, because pension schemes were focused more on partial de-risking than full buyout. That seems to have flipped over now, and in 2021 we saw about 2/3 of transactions actually being full buyouts.
Yeah, that's entirely consistent with what we've seen as well, Myles. What proportion of that 30 billion presumably doesn't include longevity swaps?
Well, the 30 billion is just the buy-ins, buyouts. Last year, we saw about 16 billion of longevity swaps. And what's quite interesting looking back over the last 3 years in the longevity swap market is about 90% of the volume has been associated with financial institutions sponsored pension schemes, and particularly pension schemes sponsored by banks.
Yeah, I agree with that. Is that linked to it? There's an accounting arbitrage, I think, for financial institutions. Certainly, we did the Santander transaction last year, and we've seen a number of banking transactions. Is that because of the accounting arbitrage?
Yeah, it's another thing for a pension scheme to take into account when you're sponsored by a financial institution, particularly a bank, where the bank has to score capital and therefore there's a real cost to it for holding risk within the DB pension plan. So the pension plan tends to be managed in a way that minimises the amount of capital cost for the bank, and for them longevity swaps are more of a DIY solution. Makes more sense than using the bulk annuity.
So I think volumes are high, or have been in 2021. What bit of crystal ball gazing, Myles? What do we think will happen in 2022?
Well, I think across the two markets we may see up to 50 billion of longevity risk removed. So 30 plus billion in buy-ins and buyouts, again with more of a dominance amongst buyouts than buy-ins. And then in the longevity swap market, maybe another 15 billion or so. I think looking at the reason why pension schemes are executing buyouts rather than buy-ins is really because of the strong asset performance in pension schemes over recent years. Many are now closer to their end game, and even closer to their end game than they were expecting to be at this point. Also, there's just a greater focus on longevity de-risking now that asset strategies have been more de-risked. And the pricing in the longevity market is one of its most attractive we've ever seen. That's really driven by two things. One, it's a competitive market, so risk fees are lower than we've seen over the past decade. And also, the best estimates that reinsurers are pricing in are lower and expected to continue to fall because of the post-pandemic data that's coming through, suggesting that actually life expectancy improvement rates are slowing.
So we've got this sort of perfect storm. We've got great pricing, we've got high volumes. So where are the insurers going to be focusing their attention, do you think?
Well, I suppose like any commercial organization, they're going to divert their attention towards those transactions where they can deploy the most capital most profitably, where they can minimize execution risk and structuring complexity. So larger transactions where there is limited complexity and a limited requirement for large teams to spend undue time and attention on transactions that, of course, they don't know that they've actually taken on board until towards the end. So I think the larger transactions will continue to dominate. There's therefore a bit of a word of warning for medium and smaller transactions coming to market, not quite as well prepared as they could be. I think the way in which pension schemes present themselves is going to be hugely important because, of course, the insurers do have limited resource and limited time to write the volumes they're going to be wanting to write.
So how is it, if you're a trustee and you're listening to this episode, how is it that you can get the insurer's attention for a de-risking transaction?
Well, I think it starts with the journey plan. It's been a bit of a buzzword over the last couple of years, particularly driven by the changing regulation and the focus that TPR's putting on pension schemes having a long-term target and a plan to get there agreed between trustees and sponsors. And actually, insurers will look for that now. They will expect that any de-risking is within the context of a well-organized strategy. And also to prepare well, to have your data in order, to know what the benefits are that you're seeking to ensure, and if there are gaps or inconsistencies in data, get those sorted before going to the market.
Yeah, so if we just pause there on residual risk, because it's a term that's bandied around a lot, and it can mean different things to different people. So what do I mean? In any traditional buy-in, the coverage that a pension scheme has is defined by the benefit spec. So to the extent that something pops out that's inconsistent with the benefit spec, let's say it's discovered that it's not consistent with historic rules, or maybe there's an error in the data that was passed over, that's not covered by a buy-in policy unless you agree otherwise with the insurer. So residual risk is really picking up those potential errors and inconsistencies.
It also, of course, includes missing beneficiaries insurance, so the proverbial file falling behind the filing cabinet, and sometimes that doesn't manifest itself as a risk until well after the buyout and the wind up of the pension scheme.
Yeah, that's absolutely right. And I think traditionally what we've seen is people have only really tackled residual risk at the end. And that's logical because it's often a conversation with the employer. Residual risk has a benefit to the employer as much as it does to the pension scheme. And so those conversations are generally tied into discussions around indemnity. What indemnity will be provided by the employer going into winding up. And actually what we're needing now is that thinking needs to be done up front. So we're working together with LCP at the moment on a 5 billion scheme that's looking to move to buyout in a sort of 10-year time horizon. And actually what we've done is trustee what's called VDD due diligence and provided a report for the first transaction. We're doing a series of buy-ins over time, and that report then supports residual risks throughout the journey plan. And that's extremely effective. But what it does mean is you have to do the thinking up front and have the conversations that you'd normally only have at the back end of the journey plan.
It's all part of preparation, really. Preparing, of course, the risks that you do know about, the risks in the benefit structure as it's defined, but then also those additional risks that you're going to want to make sure are dealt with through one form of insurance or the indemnity, as you say.
Yeah, I think that's absolutely right, and again, a theme that we're seeing that obviously backs to a large extent off the work that you did with, say, the ICI pension scheme. Are these, looking holistically at schemes, and how can we move that scheme over a 10-year horizon, using, for example, umbrella contracts and establishing panels with, say, 2, maybe 3 insurers, and then over time moving, to buy-in for the whole scheme, and then in one go moving to buyout.
Yeah, and for a number of our larger clients, that's exactly the setup that we've established, where they have relationships with a small number of insurers. The insurers know their data and their benefits very well, and in fact, sometimes we even get inbound calls from insurers suggesting that if the pension scheme has the low risk assets to pass over in a buy-in or a buyout, pricing could be favourable for a period of time, and therefore an opportunity exists.
Yeah. So if I'm a trustee and I'm sat in front of this episode and I'm thinking I'd like to transact in 2022, it's a busy market. So what are your three pieces nuggets that you can pass over to the trustees who are watching?
Well, whether you're looking to transact in the short or the medium term, clearly it's most important to have a plan and make sure that the target that you're aiming for is clearly defined, probably putting the decision around whether or not to insure in the context of the member. What does it mean for a member to be an annuitant of an insurance company? Is that, as a board of trustees, something that you're happy with in terms of the way insurers are regulated and their policyholders are treated? So having that plan with a clear end game is perhaps the first bit of advice, whether you're looking to execute in the short or medium term. Secondly, I'd say it's never too early to start preparing data, understanding your benefits, and as you rightly say, looking at vendor due diligence potentially a lot earlier than has traditionally been the case, because it will help you to decide whether you need to insure residual risks. Obviously monitoring your funding as you go, but thirdly, I'd say having the governance structure in place, making sure that trustees are aligned with their sponsors and the decision making and the objectives are well understood, and having the advisors that can potentially come in with an independent perspective on how to get the transactions over the line.
Many thanks, Myles. I think we'll draw it to a close there. Hopefully that's provided insight for the trustees who are listening, and that draws the episode to a close. Thanks very much.
Thank you.